Good evening and welcome back to Stock Daily. It's Monday, October 6th, 2025, 8:25 p.m. Eastern Time. U.S. equities began the week on a strong note, with the Nasdaq and S&P 500 both closing higher, led by impressive gains in technology and consumer discretionary stocks. Utilities and real estate also advanced, showing renewed interest in defensive yield plays. The Dow Jones Industrial Average, however, underperformed slightly, dragged down by a sharp 5% decline in Microsoft, which was weighed by leadership changes at the top. Microsoft announced a new CEO transition, naming the former PayPal chief to lead the company, news that investors initially met with skepticism. The stock's single-day drop was enough to turn the Dow into the only major U.S. index finishing in the red. Meanwhile, the U.S. government shutdown has now entered its second week. Negotiations to reopen federal operations have yet to show meaningful progress, and macroeconomic data releases have been largely delayed or suspended. With little fresh data, investors turn their focus toward corporate developments, particularly in the semiconductor and AI ecosystem. Today's standout story, without question, was AMD, whose shares soared nearly 20% after a landmark announcement involving OpenAI. AMD's rally was fueled by confirmation that OpenAI has entered into a long-term strategic supply agreement with the company. The deal involves the deployment of 6 gigawatts of AMD GPU capacity, with the first 1 gigawatt coming online in the second half of 2026. Under the agreement, OpenAI received warrants to purchase up to 160 million shares of AMD stock at $1 per share, representing roughly 10% of AMD's outstanding shares, contingent on the achievement of certain performance milestones and stock price targets. Should those milestones be met, the warrants would vest between October 2025 and October 2027, a clear signal that both companies view this collaboration as a multi-year roadmap rather than a short-term production ramp. In plain terms, this partnership positions AMD as OpenAI's second-largest supplier of AI chips behind NVIDIA, which continues to dominate the space. Management at AMD stated that the cooperation with OpenAI could eventually contribute tens of billions of dollars in annual revenue, while total cumulative chip sales could exceed $100 billion over the life of the agreement. While the headline numbers sound enormous, AMD executives emphasized that this is a long-term trajectory, not an immediate earnings impact. The financial benefits are expected to phase in gradually as OpenAI expands its next-generation data center infrastructure. This deal also exposes a fascinating financial ecosystem surrounding AI infrastructure. In recent months, OpenAI signed a $30 billion cloud services contract with Oracle, securing compute capacity for its large language model workloads. Oracle, in turn, used that contract as collateral to raise debt financing, which it then applied to purchase NVIDIA GPUs, creating a circular capital flow. OpenAI leases compute from Oracle. Oracle finances expansion through debt. That capital flows to NVIDIA and now AMD for chip purchases. OpenAI, in parallel, receives investment and equity exposure from those very chip suppliers. This recursive financing loop highlights how tightly interwoven the AI ecosystem has become, blurring the lines between customer, supplier, and investor. OpenAI remains a non-profit entity at its core, but its aggressive infrastructure expansion is funded by this intricate web of partnerships and equity incentives. From a strategic standpoint, the partnership is a validation of AMD's technology roadmap. For years, AMD has been regarded as a secondary player to NVIDIA in AI acceleration, despite its strong CPU business and growing presence in the data center GPU market. The OpenAI deal changes that perception. By securing a flagship client in generative AI, AMD gains credibility not only as an alternative supplier, but as a necessary counterweight in an increasingly concentrated market. The move could also relieve pressure from regulators and hyperscalers concerned about supply chain concentration in NVIDIA's hands. Analysts on Wall Street largely agree that AMD's potential market share in AI GPUs could climb from under 10% today to 20 to 25% by 2028, assuming continued execution on its Instinct MI series chips. In the short term, AMD's CFO stated that the OpenAI collaboration could add tens of billions of dollars in incremental revenue over several years, materially improving free cash flow projections and possibly raising EPS growth expectations by mid to high single digits in fiscal 2026 and 2027. From a valuation perspective, AMD's forward PE multiple, previously trading between 30 and 40 times earnings, comparable to NVIDIA, may now find justification at the upper end of that range. Before today's surge, the consensus 2026 price target stood around $224 per share. While new revenue estimates are still preliminary, this partnership could support upward revisions once analysts model the confirmed deployment schedule. Technically, AMD's breakout above prior resistance levels signals renewed bullish momentum. The stock closed near session highs, with $168 to $176 acting as the new short-term support zone. Momentum traders are watching for potential consolidation before any sustained continuation higher. NVIDIA, by contrast, saw a modest pullback, closing slightly lower but with strong intraday buying support. Despite AMD's headline-driven rally, investors remain confident that NVIDIA will continue to dominate AI infrastructure spending for the foreseeable future. The company's data center revenue, projected at $185 billion for fiscal 2026, is expected to climb toward $300 billion by 2029, maintaining NVIDIA's leadership position. Management characterized AMD's entry as incremental, not competitive, suggesting that OpenAI's AMD deal expands overall capacity rather than replacing NVIDIA's deployments. This statement helped stabilize sentiment and kept the stock well bid after the initial dip. In summary, while AMD's long-term growth outlook has clearly improved, NVIDIA remains the industry's benchmark, and the two companies' fortunes are more complementary than adversarial. The AI chip race is evolving into a multi-vendor landscape, benefiting the broader ecosystem. Stepping back, today's developments underline how capital formation, chip design, and AI model training have converged into a single financial loop. OpenAI's partnerships with Oracle, NVIDIA, and now AMD demonstrate how modern AI infrastructure is financed almost like a sovereign project, supported by massive debt issuance, equity swaps, and supplier credits. This mirrors early industrial revolutions, where railroads and power grids were funded through complex layers of public and private capital. The difference now is that AI infrastructure operates at digital speed, with valuations moving billions of dollars in a single trading session. For long-term investors, the key takeaway is not just the partnership headlines, but the systemic dependency being created among these companies. The AI arms race has become both a technological and financial phenomenon, where success increasingly depends on capital agility, not just chip design. Turning to Tesla, shares rebounded sharply, rising about 5% and erasing nearly all of last week's losses. The stock found strong demand after consolidating around the $408 to $433 support zone, an area that had served as a buy test level for momentum traders. Today's gains were sparked by speculation following short teaser videos posted on the company's X account, formerly Twitter. The clips hinted at a major announcement scheduled for October 7th, showing brief visuals of a car silhouette, rotating wheels, and dark backgrounds that fueled intense speculation. Some viewers interpreted the imagery as a teaser for aerial or vertical takeoff technology, possibly signaling an entry into the electric aviation or drone sector. The excitement spilled into smaller, lesser-known aviation technology stocks such as Joby Aviation and Archer Aviation, ACHR, which surged 10% or more intraday. However, these moves appear speculative. Both companies have limited commercial revenue and remain dependent on regulatory certification. If Tuesday's Tesla event fails to unveil aviation-related products, these stocks could quickly retrace their gains. More realistically, Bloomberg reports that Tesla's announcement will likely focus on a refreshed vehicle model set to enter production later this year. Such a launch could help offset recent declines in global deliveries and restore confidence in Tesla's mid-cycle lineup. From a chart perspective, Tesla remains range-bound between $408 and $470. A breakout above $407 would confirm renewed uptrend momentum, while a drop below $408 would signal renewed selling pressure. For now, technical bias remains neutral, with direction likely to hinge on tomorrow's news flow. Apple also came under pressure today, dropping roughly 4% intraday and closing down more than 14% from recent highs. Bloomberg reported that the U.S. Securities and Exchange Commission is investigating the company's data collection and advertising practices, following a whistleblower report alleging violations of App Store policies and potential breaches of user privacy consent. The probe echoes prior controversies surrounding targeted advertising and user tracking, particularly in how Apple aggregates data from social media APIs without explicit user authorization. From a valuation standpoint, Apple's forward PE of 27 to 33 times still prices in strong growth relative to its peers. However, with expected revenue growth slowing into the mid-single digits over the next 5 years, the stock's PEG ratio has started to look stretched. Technically, immediate support sits near 540 to 580, with stronger institutional support only emerging around 475 to 450s. A break below that range could accelerate downside momentum toward the mid-$400s. While Apple's long-term fundamentals remain robust, the near-term sentiment has turned cautious as investors weigh regulatory risk against still elevated valuations. Perhaps the most intriguing development this week is not tied to any single company, but to the behavior of volatility itself. Despite the S&P 500's steady gains, the CBOE Volatility Index, VIX, often referred to as the fear gauge, has also risen for 5 consecutive sessions. This simultaneous increase in both equities and volatility is extremely rare. Historical data since the VIX's inception in 1990 show that such a pattern, 5 straight days of concurrent rises, has never occurred before. Typically, equities and volatility move inversely. Rising markets compress volatility, while falling markets expand it. So what's driving this anomaly? Analysts attribute it to an explosion in call option buying, not the usual put option hedging. Over the past week, call options accounted for roughly 65% of total options volume, the highest ratio ever recorded. This suggests that retail and momentum traders are aggressively chasing upside exposure, leveraging short-dated options to amplify gains. When traders buy large volumes of calls, market makers must hedge by purchasing the underlying stocks, further fueling upward momentum in a self-reinforcing cycle. The result is a market that looks strong on the surface but is, in reality, stretched like a rubber band under tension. As long as inflows continue, prices can keep rising, but once that speculative leverage unwinds, corrections tend to be swift and severe. Beyond company-specific moves, the broader macro backdrop remains complex. With the government shutdown stalling data releases, investors have little visibility into the economy's near-term trajectory. Yet recent private sector surveys and bond market signals suggest moderating inflation and a resilient labor market. The Federal Reserve's September minutes, expected later this week, will be closely watched for hints about the timing and magnitude of upcoming rate cuts. Markets are currently pricing in roughly 75 basis points of easing by mid-2026, though Fed officials have emphasized data dependence. Meanwhile, global equity flows indicate renewed international participation, with strong buying from European and Asian funds into U.S. technology and semiconductor ETFs. This inflow reinforces the perception of U.S. tech as the anchor of global equity markets. To summarize, AMD delivered a historic rally after sealing a transformative partnership with OpenAI, marking its arrival as a serious contender in AI computing. NVIDIA remains the dominant force, but its ecosystem now broadens, benefiting from an overall expansion in AI investment. Tesla recaptured momentum amid speculation about new products, though tomorrow's announcement will determine whether that enthusiasm has substance. Apple faces renewed scrutiny from regulators, a reminder that even market giants are not immune to governance and privacy challenges. And finally, the options-driven surge in equities, accompanied by a rising VIX, underscores how fragile current momentum can be when sentiment leans too far in one direction. In essence, markets are still optimistic, but they are also tightly wound. The rally continues to depend on liquidity and speculation rather than broad-based fundamentals. Investors would do well to stay alert. Short-term exuberance often masks medium-term risk. That's all for tonight's edition of Daily Stock. Thank you for joining us, and as always, stay informed, stay disciplined, and we'll see you tomorrow at the same time.